Welcome to this lecture. In this session, which is session 5, we will be looking at IFRS 1, first time adoption of IFRS. And this is all parts of Unit 1, which is a regulatory and conceptual framework for financial reporting. So we are looking at IFRS 1, first time adoption of IFRS. At the end of the session, you should be able to describe the main content of IFRS 1 and demonstrate how an entity can transit from previous generally accepted accounting principles to IFRS using IFRS 1. So these are our session objectives, and at the end of the session we expect to achieve these two main objectives. An introduction. IFRS 1 contains rules relating to the first time adoption of IFRS. And IFRS 1 has to be applied in an entity's first annual financial statement according to IFRS, as well as in interim financial reports. The first IFRS financial statement are the first annual financial statement in which an entity adopts IFRS through an explicit and unreserved statement that the financial statement comply with IFRS and interpretation of the IAS, which is the SIC, which is the Standard Interpretation Committee, and then the International Financial Reporting Interpretation Committee, referred to as the Statement of Compliance. So an entity that prepares its first IFRS financial statement must ensure that they go through the explicit and unreserved statement that they are complying with this standard or the IFRSs and the interpretations that come from the Standard Interpretation Committee and then the International Financial Reporting Interpretation Committee, which then refers to as the Statement of Compliance. So this is what they have to do as an entity who is adopting or applying IFRS for the first time. Now, what are the recognition and measurement when it comes to IFRS 1? For accounting policies, the standard says that an entity has to use the same accounting policies in its opening IFRS statement of financial position throughout all periods presented in its first IFRS financial statement. So what it basically means is that if you are adopting a new standard, the accounting policies that you use at the date of transition, the opening IFRS statements of financial position must be the same throughout all the periods that you are going to present your first IFRS financial statement. I will explain that one later based on the number of financial positions you have to prepare. Now, however, if IFRS 1 does not apply to changes in accounting policies made by an entity that already applies IFRS, so you are saying that with this clause that you have to use the same accounting period policies when you are preparing your first time financial statement, if you are an entity that already apply IFRS 1, this clause does not relate to you because you are already applying IFRS. And if there is a need for you to change a policy and it becomes prudent, you just have to go and then do that change. And then the other exemption is where the accounting policies that an entity uses in its opening IFRS statements of financial position differ from those that the entity used for the same date according to its previous gap. So what the standard is basically saying is that aside you um, or the standard does not apply to you when it comes to accounting policies if you are already using the IFRS standard. And in addition, if the accounting estimates or policies that you are going to apply at the opening date is different from those that the entity has used in its previous year, then you are exempted from ensuring that the same accounting policies is what applied at the opening days of financial statement and the subsequent years. So there are only two conditions that will exempt you from doing that. One, you already have an existing or you are already subscribed to the financial standard. And two, the one you use at the opening statement is different from what the entity used using its previous gap. So if that is the case, you are exempted from ensuring that or making sure that the policies or the accounting policies will be different. Now, how then do we apply? We are making a change. What is the application procedure? So I have what we call the retrospective application. So a first timer adopter or a first time adopter has to apply IFRS retrospectively. What it means is that you go back to the past and use the same standard or the new standard to re-prepare your financial statements in the past as if the standard was existing as at that time. Then we have the mandatory exception to retrospective application. IFRS 1 prohibits retrospective application of some aspects of other IFRSs. So when we have some other IFRS and then they are dealing with specific item, the standard prohibits this retrospective application. So for example, we say an entity statement according to IFRS that are necessary when preparing its opening IFRS statements of financial position have to be consistent with estimates made for the same date with regards to its statement of financial position according to the previous gap. So if you are preparing your statement or the transition date, you are restating, it said that there is a prohibitory word. It allows you to, or you are exempted from this retrospective application for this kind of estimate. Talk about how you measure depreciation, the depreciation figure and co. The amortization figure, if you go back, it might be a problem. So you can't go back to do this retrospective application for certain standard. IFRS 1 do not encourage that and prohibit retrospective application for some aspects of other IFRSs. We have optional exemptions for other IFRSs. We have certain items that certain individual standard deals with them specifically. An example of that is measurements of property, plants, and equipment. So we have a whole standard IAS 16 which deals with this. Then we have foreign currency reserve, a whole standard of IAS 21 talks about it. Then we have the deferred tax, which will result from temporary difference, and this temporary difference can either lead to what we call the deferred tax asset or deferred tax liability. And the standard that talks about this is IAS 12, income tax. So where a certain standard or IFRS deals specifically with an item, and if that item fall within first time adoption of IFRS, we allow, or there is an optional exemptions for that, so that it can be dealt properly with the individual standards that describes it. Then we have the presentation and disclosure requirement. It said the entity's first IFRS financial statement have to include at least three components of financial position. And these three components of financial positions are the statements of financial position for the comparative period. We have the statements of financial position for the transition date, which is the earliest, and then we have the statements of financial position for this reporting period, making three. So this is how it is. If we are adopting a new standard, or we are adopting a new standard this year, 2023, that will take effect from 1st January 2023. So, but we are going to prepare our financial statement as at 31st December 2023. So 31st December 2023 is the reporting period. So that is one statement of financial position. Two is the transition date, which is 1st January 2023. And then we will take 1st January 2022, which become the comparative period, the earliest comparative period. So we are looking at the earliest comparative period, we are looking at the transition date, and we are looking at the reporting date. So these three financial statements or statements of financial position must be prepared. So this also means that it is also necessary to present the opening IFRS statement of financial position. This is necessary, the opening one, the transition date, you have to prepare that. So it is either to present two single statements of comprehensive income, which will be a one statement approach, or you present two separate income statements and two separate statements of comprehensive income, which is also going to be a two statement approach. Then we look at two statements of cash flows, two statements of changes in equity, the related notes, including the comparative information for all statements presented. Let's take an illustration, and it is in the book. I would advise that you read the textbook to get more understanding, solve more questions as well. So at the end of the year 2010, entity MTK was sued for damages. In MTK's statements of financial position as at December 31st, 2010, according to MTK's local GAAP, a provision in the amount of 40,000 was recognized because MTK expected that it would ultimately have to pay damages. However, contrary to expectation, MTK won this lawsuit in November 2011, and it is presumed that MTK would also have had to recognize a provision in the amount of 40,000 cedis if MTK had already applied IFRS when preparing its financial statement as at 31st December 2010. Now, what are we supposed to do? We are to assess the accounting treatment of the event described in MTK's first IFRS financial statement as at 31st December 2012. Now, this is a transactions that span between 2010 to 2012. The lawsuit actually started in 2010, and then decision was made on 2011. Now we are going to prepare the financial statement for 2012 to correct or adjust the treatment. So what then comes here? We are basically saying that the court decision in November 2011, where the verdict was given, represents an adjusting event. However, the court decision could not be taken into account because it took place after MTK statement as at 31st December 2010 were authorized for issue. So after auditing, they have to now go through it, and then what? Shareholders will authorize it for it to be issued. So this authorization has been done before the court has finally given its verdict. So MTK's estimate, according to IFRS, is that are necessary when preparing the opening IFRS statement of financial position as at 1st January 2011 have to be what? Consistent with estimates made in the same date with regards to what? The statement of financial position according to its previous cap. So we are looking at 31st December 2010. So whatever accounting estimate that you are going to make, which is a 40,000, must be consistent with whatever you have disclosed or made provision for in 2010 account. So what this basically means is that the court decision that took place in November 1st, 2011 must not be reflected in MTK's IFRS statement of financial position. So it's not going to reflect there. So how then do we go about it? As far as it's not going to reflect, hence MTK's opening IFRS statement of financial position also includes what? The same provision in the amount of 40,000. So when we take the statement of financial position as at or its opening financial statement, it has included this 40,000. So we say it is a provision, it's an expense. So we debit provision, and then so the provision was actually credited. When you make provision, it's a liability, and then they have debited profit or loss account with the aim that they are going to what? Lose the case. But that is not the case now. They have actually won the case, and then the adjustment or the reversal have to be made on 31st December 2011. Let's get a scenario. The lawsuit started in 2010, but as at the time they were issuing the financial statement, the result of the court were not ready. It was ready on November 1st, 2011. Now you are going to prepare 2011 financial statement, which ends in December. So the adjustment would now be made as at December 2011. So in 2011, since the law case has been won by the company, the entity has to now go and de-recognize the provision that they have made. So we recognize the provision that if you lose the case, you're going to use to pay. Now you won the case, so you have to go and de-recognize what? The provision that you have made at the end of the day. So you are going to de-recognize it in 2011. So this will affect what? The comparative period in 2011. So we are looking at 2012. So 2011 become your comparative period. 2012 become the date of transition, and then the reporting period. So how then is the error corrected or this transaction corrected? Provision is having a credit balance sitting down there. We are de-recognizing the transaction. So what you have to do is to credit your other comprehensive or operating income, then you debit provision. So provision is having a credit balance 40,000. If you debit it, then you have de-recognized that account to be zero. And then what you have recognized in other income or other operating income of 40,000, which is initially an expense that went to profit or loss account, you reverse that one as well. So you have to just debit provisions 40,000. The corresponding credit entry goes to other operating income. So that is how we solve the question or the illustration 2. Just take your time, go through it, and then you'll get it. You have to read more, practice more. That is what will make you perfect with that. So in summary, we have been able to look at IFRS 1, first time adoption of IFRS, its presentation and disclosure requirements. In a subsequent lecture, we'll be looking at unit session 6, which has to do with fair value measurement, IFRS 13. So we'll meet for the next lecture. Stay safe. Thank you very much.